Greetings and welcome to this FairTax presentation. When examining any new tax system, perhaps the most important feature to consider is the impact it may present to purchasing power. That is, how much more or less of the items we purchase today can we purchase of the same after implementing a new tax system. In this short presentation, one based on a paper by David Turek of the Beacon Hill Institute at Suffolk University, we will examine, and from one perspective for the tax year 2014, the purchasing power of the federal income and payroll tax system against that of the proposed FairTax. The FairTax is a national retail sales tax that replaces all forms of federal income, payroll, and corporate tax. It also includes a monthly consumption allowance that reduces or eliminates the regressive effect of a sales tax and with very much the same impact as the standard deduction and personal exemptions allowed under the existing tax system. In our examination, we will use the typical American family comprised of 2 adults and 2 children with a combined earned income of $50,000. An amount slightly less than the annual median income for American families in 2014. To compare the 2 tax systems for their respective purchasing power, we will use a single product called a widget, and there are 50,000 of them available for purchase. Under the existing tax code, each widget will be priced at $1. Under the FairTax, the gross amount, that is the combination of the product price and the proposed sales tax, will be increased to $1.30. I have kept the product price the same and included the full weight of the sales tax, 30%, to present the FairTax in a worst possible but highly unlikely case. As we apply the 2 tax systems, the amount of widgets we cannot purchase are those sacrificed to the government, and their percentage of the total available represents the sacrificial effective tax rate. The lower this tax rate, the more widgets the family can purchase, thus revealing the tax system with the better purchasing power. To compute the family's income tax consequence, we will use the married, filing jointly, standard deduction, and personal exemptions identified with the 2014 IRS Form 1040. The standard deduction is $12,400, and the 4 personal exemptions at $3,950 each totals $15,800. Subtracting the deduction and personal exemptions from the family's earned income reveals the taxable income, $21,800. Referring then to the tax tables for married filing jointly, we find the income tax due for our example income is $2,820. In addition to the income tax consequence, we also need to include the payroll taxes assessed on this family's earned income, which we will limit to just the employee share of Social Security and Medicare taxes. The self-employed have double the tax consequence, and so too employees, but that discussion is left to another presentation. At 7.65%, the amount of income seized for payroll taxes from this family is $3,825. And when added to the income tax amount, the total income and payroll tax consequence is $6,645. Next, we subtract the total tax amount from the family's earned income amount of $50,000 to determine how much money they have left, which is $43,355. With this amount, the family can buy 43,355 widgets that each cost $1. The remaining widgets, which they cannot buy, 6,645, are the number of widgets sacrificed to the government. We can now determine the family's effective tax rate. First, dividing 6,645 by 50,000, and then multiplying the quotient by 100, which gives us an effective tax rate of 13.3%. Now we will determine the sacrificial effective tax rate for the FairTax. We will begin first with the family's income of $50,000 and add to that amount the annual family consumption allowance for a family of 4, which in 2014 was $7,236, giving us a total of $57,236 to spend. Next, we divide the combined income and allowance of $57,236 by the widget gross amount price of $1.30 to obtain the amount of widgets that can be purchased. And that number is 44,027. Subtracting this figure from 50,000 available widgets gives us the total number of widgets sacrificed to the government, 5,973. We can now compute the sacrificial effective tax rate as 5,973 divided by 50,000, and the quotient multiplied by 100 gives us 11.9%. Now we have two sacrificial effective tax rates specific to purchasing power that provide a reasonable comparison of the two tax systems and in their respective tax economies. The existing system with a rate of 13.3% and the FairTax with a rate of 11.9%. In this case, the FairTax has a 1.4% advantage over the existing income and payroll tax system, a result achieved too using the worst case scenario for the FairTax, that of a full application of the sales tax and none of the foreseeable reductions to product and service prices. What we take away from this example is that the typical American family of four with a median income of $50,000 has a greater purchasing power with the FairTax than they currently do with the income and payroll tax system. In other words, no matter what the family spends their income on today, they can purchase the exact same items and more, even with the addition of state and local taxes under the FairTax. It also points out that the 30% tax assessed on any product is not, in effect, a 30% tax, but one far less as a consequence of the family consumption allowance. I encourage you to learn more about the FairTax at www.fairtax.org. The FairTax, the right tax system for you, your family, and our nation.